Hey everyone, so following on from the interview I had with Gary Yeolman at Voxtur Analytics, today I'll go through some analysis and an attempted valuation. But I'm totally going to skim over the real deep analysis of this company because you can find that out for yourself on Mariusz Skonetzki's YouTube channel. That is a great starting point. Please do that if you're really interested. See, Mario did help Voxtur raise some money, so just be aware that it might come across a little bit salesy. Now, regardless of the incentives, the analysis of the company he did is good for a deeper understanding. He really has done a lot of the heavy lifting on this one, so thank Mario for that. Today is just going to be my super fast summary of what Voxtur is. It's a company in the real estate. It's a real estate tech company that is fixing a handful of really old school problems in real estate in North America. And the core problem that they're trying to solve is that there are just a lot of fees and there's a lot of time involved in closing the sale of a house. See, there's titles, appraisals, tax regulations, there's lots of stuff going on. These things normally are added on by agents for extra fees or done manually. Now, Voxtur are bringing a better, cheaper technology to speed all this up and get the costs far lower for the customers. It's a clear win-win for most people involved. It appeals to me because it's a roll-up of software businesses to solve a pretty annoying and a pretty big problem. So how I see it simply is that any complicated manual paperwork task that can be improved with software and save a lot of money for people, well, that's probably going to work. Regardless of whether a recession hits, people fundamentally will want to save money, and Voxtur saves people time and money. And I like the industry and the software-based solution. There is a bit of a nuance to the industry that I'm still not familiar with, and because I haven't bought or sold a house in America, but luckily there are plenty of people who have done that before and I can talk to them. Now, regarding things like competitive advantage, there are other players in this space looking to solve the problems in real estate transactions. Data is a competitive advantage where Voxtur's acquisitions have been working hard to get the best, most extensive data sets they can. This is something that Gary understood and is always looking to improve, and I like that. But the competition are doing it too. And I haven't gone through each of the competitors yet in detail to see where they are at. So look, there's still some digging for me to do there. This video is more about valuing the business and seeing if it is worth digging even further into. You can be the judge of that yourself. Now, regarding making the actual investment, if I did do this, I will have to use Interactive Brokers because that gives me access to the Toronto Stock Exchange. It's the broker that I use and gives me access to most markets of the world, and it's a very safe broker. It isn't a startup like Robinhood or anything like that. And if we already take enough in risk in investing, and we don't need something like the FTX event happening to our stock market portfolios. Anyway, there's a link in the description. Take a demo account for a spin, see how it feels. Now, I'm not going to give my opinion on the management. I thought the facts can speak for themselves in the previous video I did where I interviewed Gary Yeolman. See what you think for yourself. But management are going to be a pretty big factor, maybe the biggest factor in this investment because they have a lot of execution to do. Can they pull this big play off? Possibly. I don't know, of course, because I can't predict the future. So here are some metrics that I find pretty impressive. I like that insider ownership is really high. 33% gives a strong incentive for the management as they have a lot of skin in this one. So here on the screen is an investor presentation and it's just showing you that there's just been massive growth, 368% year-on-year growth from 2020. There's a big jump there from a lot of acquisitions, plus huge amounts of actual growth as well, just generally speaking. And yeah, gross profit has declined quite a bit as well over that period of time. They're just in high growth mode here. And something on the next page that I really like to see is that the selling and business development expenses have gone up very dramatically, which means they're pouring money into sales, just raw getting money into the door. General and admin has increased as well, and tech and operations has increased, but the amount of spend. But the big jump there is in selling and business development, which I think is exactly what they should be doing if they want to grow this thing big and get as much market share as possible. Sounds totally fair to me. Now, this is going to get really tricky. They are still in this ultra growth mode. So no free cash flow, no profit to speak of. And it's really hard to adjust out the growth expenses to get a feel for the underlying profitability. Now, I could use comparables to other companies in the real estate tech world, but look, I don't do comparables. This isn't my style. just because 5 tech companies have price to sales ratios of 20 doesn't make it a fair price for Voxtur. I don't like comparing things. The question I want to get to is, what feasibly can I see EBITDA margins or free cash flow margins being when they aren't aggressively growing? The good thing is that management seem keen to show this over the next year or two. A bit of a consolidation to prove the strategy and prove to the market that they can be profitable. So I guess I can look at other SaaS businesses to get a feel for free cash flow margins. And I would consider these like mature SaaS businesses. You got Salesforce at about 20%, ServiceNow at 25%, Atlassian's about 30% free cash flow margins. But maybe a better place to look is just real estate SaaS businesses specifically. So we've got CoStar at 20%, Altus Group is 8%, RealPage Inc. is about 20%. So ranging from about 10 to 20% free cash flow margin seems a good place to get a ballpark. But look, I'm assuming a lot here. I'm assuming things get to this point where the business can actually turn the cash flow into free cash flow. That's a huge assumption, but it is how we're going to get some upside scenario of a valuation here. Okay, so my first valuation here on the screen is I'm assuming zero growth. So I'm saying that they're not even going to grow at all. They're going to maintain where they're at the moment. Even though they've put all this money into sales and business development, I'm saying they're just going to really consolidate and nail down operations for the next 5 years. And they're not going to make any acquisitions because they're not growing. So they're not going to dilute. I'm going to give them, I guess, a fair PE of a company. Even that's probably too high for a company that's growing at 0%. So anyway, current market cap, shares outstanding, current revenue. We're saying that even at zero growth, we're probably talking like maybe 5 to 12% compound annual growth rate over the next 5 years, which is pretty cool to think that the business can do nothing but consolidate and do no growth at all, even though they're growing rapidly, and still you're going to turn into a reasonable return on your investment. So that's probably definitely some sort of base case scenario. Then I've got revenue growth rate at 20%, so significantly higher, of course, but last year they did 360%. So these are all just numbers. I'm just throwing numbers around here just to see what would happen. And we're talking at a 5-year compounded growth rate now at 34% per annum. That's insane. Now I'm looking at 40% revenue growth rate, turns into 56% per annum. As you can see, the upside is getting silly here. And what I've done here is because it's growing so fast at 40%, I've got a fair future PE now at 30 because it's growing at 40%. It should be probably 40 PE, but let's call it a 30. And we're getting an 84% compounding growth rate. Look, these are just wild, random, nearly random numbers. Not exactly random. I am using some basic guidelines here. I am using the shares outstanding and the current market cap and a free cash flow multiple and a 15% margin, free cash flow margin as well. So I guess this is in the realm of possibilities, but yeah, there's some serious ranges there from 5% to 85%. Oh, and sorry for all that background noise. I'm at my family's house for Christmas at the moment. I'm recording this in advance. That background noise is kids in the house and stuff like it's Christmas. You get it. You know what's going on. Now back to those valuations. Honestly, there's a lot of guesswork there. There are a lot of things that I haven't figured out yet. It feels like I'm gambling if I invest at this at the moment. But I guess I can see the big upside as well. And my gut feel at the moment is, I guess it's a high risk, high return. And if you know me and my style, I like low risk and high return. So for me to get on board, I would have to figure out how to understand enough to lower this perceived risk. That's okay. Not every investment is perfect for me. This might really appeal to you and for something for you to dig into. I totally understand that there is a world where this goes up 20, 30x in a short period of time. I see that scenario. All the business has to do is show they can turn the revenue into strong free cash flow and the stock will shoot up. But then it'll be too late to invest. So yeah. But I do like that they are solving a really big problem and saving people money. I like saving money, so it would appeal to me, and I'm sure it appeals to people in the industry. And also I like, obviously, that they have lots of growth. That is what makes this investment really interesting. And what I don't like is that I can't see whether the acquisitions have been accretive yet or not, but I guess that's just part of the business. All the different acquisitions bring different data sets to the table to make a better overall solution. So it's impossible to separate it out. Not like a serial acquirer where separate businesses are subsidiaries and they really separate them out. So it's not like that at all. And I still just don't know enough about the competition, and I don't know enough about the management either. Now, I'm sure a lot of people out there have more information to add to this one. Feel free to join my Discord group or just leave a comment here in the video to tell me what you think about Voxtur. I hope you've enjoyed. Sorry about the crazy valuations that are all over the place, but it is what it is. It's really hard to value. Thanks for staying to the end of the video, and I'll see you in the next one.